let's get started. How to reduce your taxes. So what we're talking about with all of these webinars and all these discussions is financial planning. Well, what is financial planning? You are going to have a financial life of some sort, whether you plan on it or not, whether you act intentionally or not. And whether or not you get to actually do everything you want in life depends on a lot of things, a lot of random things. I mean, it's overwhelming just thinking about it. But I can tell you this, without trying to be intentional, without some planning, you're most likely not going to get there. Unless you win the lottery or something. Of course, then your wants and needs all change. But this is how I think about it. Door one and door number two. Door one, afford everything you can. Door two, miss out. If without planning, you're more likely to miss out and go through door number two. So what is planning? Here's how I view it. There's 4 areas. Protect what you have. That's insurance and estate planning. Know where it goes. That's spending. Make it grow. That's investments. Retain independence and dignity. That means we're going to think long term. We do all this with intentional and purposeful effort to build your best financial life, not the best financial life on the block, not the best financial life among your friends, but the best financial life for you in what you want out of life, in getting our clarity in our finances. Now, here's the process that I go through. And again, I'm not sharing this to be a sales pitch. I just want you to see what financial planning is, and we'll talk about how taxes figure into that. So if we're going to do planning, we need to know where we're going, what we want. We need to understand the current situation. We need to understand our future situation, where we're headed in the near term and the long term. And then, of course, we need to review that. Now, what part of this do you think is affected by income taxes? I'll give you one guess, and here's the guess. All of it. Taxes are everywhere. In every financial decision, pretty much every financial decision you make, taxes are going to enter into the equation. Now, that's okay. We all want to pay our fair share of taxes. We don't want to pay $1 more, right? So how do we do that with a tax code that's so complex? Well, we just got to pay attention and understand what to do. So I'm going to talk about 5 areas here in a moment. But before we get into that, let's understand how taxes work. Number one, if you want more take-home money, make more money in the gross sense before taxes. Always, 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 if you make more money, you're going to have more after taxes. Never do you get taxed more than you make, unless you really mess things up. So don't be afraid to make more money, even if your tax rates go up. That's okay. That's a trap sometimes people fall into. If we take a longer term look and think about the money you're going to make over your entire lifetime, if we want to minimize tax, then we should make the exact same amount every single year through our life. Now, obviously, we can't choose to do that. Our careers progress and our incomes go up. But that's a good just sort of mathematical model when thinking about whether or not if we can move income from this year to next year. We want to know, well, what's my total income going to be this year? What's my total income going to be next year? I'd like to work towards getting those to be even, because I know, generally speaking, I'll pay lower tax. Now, why is that? Well, here's why. Our tax system works in a progressive sense. And it's not political. It's progressive in the sense that the more you make, the higher percentage you pay. So if you only make 20,000 bucks, you pay 10%. If you make 80,000 bucks, you pay 10% on the first 20,000, and then you pay 12% on the next 63,000. This is for married filing jointly, but it works the same way for singles. So just ramping up, if you're up here in the 24, 32% bracket, 22 or 35, 37%, wherever you are, just know that this stair step only applies to the marginal difference. So if you're in 35% bracket and you make $647,851, then $647,850 would be taxed at 35%, and $1 would be taxed at 37%. So don't worry about making more money and try to even out your income. Okay, so let's go through the 5 tips that we have here. Number 1, Roth contributions. Now, you might think that's funny. Well, wait a second. If I put money in a Roth, I don't get a tax deduction. So aren't I paying more tax today? Yes, you absolutely are. But these aren't tips about paying less tax today. These are tips about paying less tax over your life. And with a Roth account, you put money in, you don't get the tax deduction, then it grows, you invest it and it grows. And guess what? You never pay tax on that growth. It's one of the few areas where the IRS says you can earn money and pay zero tax. That's the attractiveness of Roth accounts. So Roth contributions. So can you put money in a Roth? Well, you're very limited on income. If you're married and you make, and combined, you make over $214,000, you can't put money in a Roth, not a Roth IRA. However, most employers offer Roth 401k options. So within your 401k, you have the ability to take a deduction or not take a deduction. If you don't take the deduction, then that money typically is filtered into a Roth 401k. When you leave the employment and you move the money out, you can move it to a Roth IRA, no taxes, no fuss, no muss. You get all that growth without paying tax on the growth. So Roth contributions are great. Now, again, you are paying more tax today, but the idea is to lower your tax over the long run. You want to do this, especially in your lower taxable income years. I know nobody told me when I was 22 years old I should do this, but that's when I should have been doing it. That's okay. It's never too late. If your income is on a growth trajectory, then this is great for you. Even if it's flat, if you have a long time that the money's going to be invested, so it gets to grow quite big, that's a big tax advantage where you're not paying tax on that growth. Number two, somewhat related, Roth conversions. So we have Roth contributions. That was number one. That's where we're putting money into a Roth account out of our paycheck or otherwise. A Roth conversion is where we take an old traditional IRA and we convert it to Roth. Now, if we have $100,000 in a traditional IRA and we convert it to Roth $100,000, guess what? You're going to show $100,000 of income this year and you're going to pay tax on it. That's the whole point. You're putting in Roth, you pay tax today. That's going to come out of your pocket. That does not come out of the account. You can pull it out, but there's all kinds of penalties and you don't want to do that. So if you have extra money today, and extra money, everybody wants to have extra money, but if you have traditional IRAs, you can convert them, pay tax today, and again start that clock ticking where you get all the future growth without paying tax on that Roth portion. So the money grows. Don't pay tax, take it out in retirement, or your heirs take it out, wherever, it doesn't matter. It's not going to pay tax as long as we follow the withdrawal rules, which are basically all around retirement. Now, there's a catch to this. You cannot do this. No, that's not fair. You can do this, but you don't want to do this if you have basis in any of your traditional IRAs. What the heck is basis? That means if you have non-taxable money, money that you've paid tax on already in an IRA. Okay, if you do, then you don't want to do this conversion. Now that's a weird little problem. Most people don't have that, but some people in the past have put money into IRAs and not taken a tax deduction. That totally messes up this whole Roth conversion plan. There's ways around it. You can work on, you can do some things to figure it out and make it work, but you can't just do it off the top. Okay, that was number two, Roth conversions. Number three, asset location. Here we're talking about your investment portfolio, your long-term investment portfolio. Now there's three different types of accounts. There's regular old brokerage accounts, taxable accounts, just like the stock that you get. Once your RSUs vest, they're in a taxable account. You can sell them and take them out. You can sell them and buy other things. You can do whatever you want with it. That's a taxable account. It's called a taxable account because the things you do in that account are taxed today. Taxable account. Number two, traditional IRAs and traditional 401ks. That's where we've taken the tax deduction by putting money in, and we can trade, do all kinds of things without paying tax today. And then we pay tax when we take money out in retirement or whatever. And then the third is the Roth that we've been talking about, where you don't take you don't take a tax deduction today, so you're paying tax on that money, but you're never taxed again. So tax today, tax tomorrow, never taxed again. That's the three types of accounts. Asset location, if we're buying high dividend stock investments, and we're buying high yield bond investments, and we're buying growth investments that don't pay any dividends, where do we put those? Well, for the taxable accounts, we want our low income investments. That might be our growth stocks, or stocks that are not paying dividends. These also should be holdings that we expect to be long term. If we're gonna, that's what the whole low turnover means. If we're gonna trade this account, we don't really want them in taxable accounts. Sometimes you can't avoid it, but you don't really want it there because you're gonna create all these taxes that you have to pay today. For traditional IRAs and 401ks, here, this is where we can have our high turnover. We can trade as much as we want. We can have our high income investments. That's where our bond investments live. If we can make that happen, because we're not taxed with that income coming in. We're just taxed when we take the withdrawal in retirement. Roth accounts, that's where we supercharge things. We put our highest expected earning investments there. Remember, highest expected earnings means highest risk, so we might see a lot of volatility. But if we're going to have money in a Roth for a long time, and we know we're never going to pay tax on the gains in that, don't we want the best performing investments there? Yeah, we do. So this is another way that we can pay less tax, is by optimizing our asset location for our investments. Okay, number 4, charitable donations. Now, this is only if you're already giving to charity or you already want to give to charity. There's no way to get a lower tax rate and get more money in your pocket by giving money to charity. Doesn't work that way. Just like making more income is always better, no matter what the tax rate is. Giving money to charity, yes, there's a tax benefit to that, but it never outweighs the money that you actually gave to charity. You have to want to give to charity. Now, if you are in that situation, there's a great little trick here, depending on how much you give to charity each year. So when we do our taxes, we calculate what's called a standard deduction. We calculate our gross income, and then we can take a standard deduction of $25,900 and then pay tax on what's left. Or we can itemize and maybe pay tax on what's left. Now, depending on your situation, you might be in a position where, for example, this couple normally gives $20,000 a year to charity. Well, if they give $20,000 a year to charity every year and they have no other deductions, they're going to always deduct how much? $25,900, the standard deduction, because you can take that without giving anything to charity. But if they change things up and say, you know what, instead of giving $20,000 each year, let's give $40,000 every other year, then they can take a $40,000 deduction in one year, the year that they give the money, and the next year they give zero, but they still get to take the $25,900 deduction. So work those deductions from year to year if you're giving money to charities on a regular basis. That's number 4. Number 5, company stock sales strategy. Know your company stock, what it is, and how it's taxed. This is where I see so many people doing exactly the wrong thing. It has to do with RSUs. And here's the reason. When RSUs are given to you, when they're awarded to you, and they say, hey, you've got $100,000 in RSUs, they're going to vest over the next 4 years. Guess what? You didn't receive a thing. You don't have a thing. You only receive it on the vest date, on those four vest dates in the following years. Now, what happens when we get to the vest date is this: the IRS says, aha, you just received $25,000 in stock as compensation for working. We're going to tax you on that. And they tax you immediately as of that day. You've probably seen that the brokerage where your stock is held, they automatically sell some stock and they send it off to the IRS. So what that means is it's as if you bought stock on the vesting date. Let me say that a different way. Vesting, having stock vest and holding it is the same thing as if your company gave you a paycheck and you turned around that day and you bought stock in the company that you work for. How many of you have done that? Raise your hand. Probably none of you. But you're doing it if you're allowing your RSUs to go past vest date. So here's a way to lower your tax. If you sell your stock on vest date or shortly thereafter, you're going to pay no capital gains tax because the stock hasn't moved. You've already paid tax on the dollar price that the stock vests at because the IRS is going to force you to do that. But if you hold it, now you're setting yourself up with some portfolio risk, some concentration risk perhaps, and of course, capital gains and capital loss scenarios for in the future when you do convert that to your long-term portfolio. Now, we know your stock is going to convert to the long-term portfolio at some point. You're not going to hold company stock forever and ever and ever like you will your long-term portfolio. So we know we're going to sell it. Why not sell it on vest date when everything is even with the IRS? They've already taxed you. There's no benefit to holding. And you've already got exposure to your company because you work there, you get a paycheck and all those things. So that's my 5 tips. And that's pretty much the webinar. You're going to get an email with a link to these slides. Here's what I want you to do. Download these slides. Consider whether you're taking advantage of these 5 ways in the best way for you, right? What's best for you? Some of them might be good for you, some of them maybe not. And once you consider that, schedule a call with me and let's talk about it. I'm going to put a link in the chat right now. I can't talk and type at the same time, so I got to get quiet. I did it right. I'm putting a link in the chat to everyone. Hopefully you can see that. You can click that, schedule time with me, or save the link and schedule time with me later. Happy to have a conversation with you. This is a $300 value. I normally charge $300 for my coaching sessions. This is a 45-minute session. We can talk about this, any other topic you want. And again, I promise no cost, no sales pitch. This webinar is not financial advice. I can only give financial advice for you and your specific situation. I'm speaking generically today. So please know that. Don't rush right out and act on this. Think about it and talk to me, and we'll discuss what's right for you. I do have several other topics for webinars that are out there. If you'd like to see them, I have a YouTube channel. I have a podcast as well as a blog. My website's bestfinlife.com because bestfinanciallife.com was far too expensive and I was unwilling to pay for it. We do have, as always, another webinar coming up. Our next webinar is August 11th. We moved it to the second Thursday because we had a little scheduling conflict. And this is going to be on how to manage your ESPP. So if you get an employee stock purchase plan, come to that webinar and we'll talk all about that. And there's the disclosures. Yeah, everybody read that. Okay, so let me put this back on. Oops, put it back on here. We got the link in the chat. Happy to take any questions on this topic or any others. Just put them in the chat or the Q&A and let's get to it. I'm going to take a sip of water and take a look. Here's a specific one. Let's go to this slide. Question: above the 214K, isn't backdoor Roth an option? Yes, absolutely. This is what I was talking about, where there are no income limits for contributing to your Roth 401k. Some people call it a backdoor Roth. It is technically a backdoor Roth. You don't need to understand. Here's what happens. There's a traditional 401k. Everybody has a 401k, has a traditional 401k. You have to have that. That comes first. Then companies can add on a Roth 401k. So what happens when you put money in the Roth 401k, it never goes directly to Roth. It has to go in the traditional first, and then Fidelity or Charles Schwab or E-Trade or whoever automatically moves it over to Roth themselves. That's the backdoor part. Very technical speak for people in the business. You don't have to worry about that because they take care of that for you. Just make non-deductible contributions And of course, make sure they go into a Roth account, make sure your employer allows that. So hopefully I answered your question there. And I don't see any other questions, but I will wait for a couple minutes. Again, throw a question in the Q&A or the chat. Happy to stay on for a while. Otherwise, if you're ready to get on with your day, please do so with my blessing, and hope we connect soon. All right. I think that's it. I see people dropping off. I don't blame you. The weather's nice out if you're here in California. Take care, everybody. I hope to see you again in August, where we'll talk through how to manage your ESPP. In the meantime, schedule that time with me. Happy to have a conversation. And thank you, Karen, and everybody else. Take care.